Picture a Tuesday morning in late February of 2026. The winter air outside the glass windows of a Silicon Valley high-rise is perfectly crisp. But inside the boardroom, the atmosphere is suffocatingly dense. On the massive mahogany table sits a term sheet. The headline number printed on that document is $110 billion. For a moment, let that number wash over you. 110 billion. That is not a Series A or a Series B venture capital round. That is a figure larger than the entire gross domestic product of more than 120 sovereign nations. It is a sum of money that bends the very fabric of financial gravity. At first glance, a casual observer might look at that number and see the ultimate validation of human progress. They might see an unstoppable juggernaut cementing its place as the apex predator of the 21st century digital economy. But if you have ever built a company from the ground up, if you have ever looked at a system architecture diagram and searched for the single point of failure, you look at that $110 billion and you feel a cold chill run down your spine. You do not see a victory lap. You see a terrifying, desperate, and heavily engineered lifeline thrown to a drowning giant. Welcome to the grand illusion. Today, we are taking a scalpel to the most spectacular financial anomaly in modern technological history. We are going to deconstruct the collapse of the artificial intelligence boom, not by looking at public relations statements or slick keynote presentations, but by examining the raw, unforgiving plumbing of the system. We are going to look at the unit economics, the server costs, the thermal dynamics of data centers, and the terrifyingly fragile capital loops that have kept this entire machine running. Speaking as a serial founder, when I see this kind of cash burn model, I know they will not last 3 months without a structural miracle. And yet, this particular company has managed to distort reality for years. To understand the magnitude of this structural fracture, we have to rewind the tape and examine the foundational logic of the generative artificial intelligence era. When ChatGPT launched in November of 2022, it broke every single user acquisition record in the history of software. 100 million users in 2 months. It felt like magic. You typed a prompt and a machine spoke back to you with the nuance and coherence of a human being. But the fundamental law of the universe is that magic always comes with a hidden cost. In software engineering, we are used to a beautiful economic concept called zero marginal cost. If I write a piece of code for a mobile application, it costs me a certain amount of time and money to develop it. But once it is compiled and uploaded to the App Store, it costs me virtually nothing to distribute it to one person or 1 million people. The code simply duplicates. The profit margins approach 99%. This is the error dividend that built the empires of Microsoft, Apple, and Google. It is the fundamental physics of the internet boom. But generative artificial intelligence entirely broke that physical law. Every single time a user types a prompt into a large language model, there is a physical thermodynamic event happening in a data center somewhere. Thousands of graphics processing units, incredibly sophisticated chips that cost tens of thousands of dollars each, have to wake up. They have to pull immense amounts of electricity from the local power grid. They have to run billions of mathematical matrix multiplications across massive neural networks in real time. The cooling systems have to kick into overdrive to prevent the server racks from literally melting down. All of that hardware, all of that electricity, all of that infrastructure costs a staggering amount of money. In early 2023, just keeping the basic free version of the model online was burning through $700,000 every single day. And that was just the beginning. As the models became larger, jumping from version 3.5 to version 4, and eventually to version 5, the parameter count exploded. More parameters mean more computational overhead. More overhead means more server time. More server time means a terrifyingly steep spike in the cost of goods sold. In engineering terms, this is a classic unscalable architecture. It is like designing a massive, beautiful, multi-lane highway, but requiring every single car that drives on it to be personally pushed by a team of highly paid mechanics. The more successful the product becomes, the more traffic it gets, the faster the company bleeds to death. By late 2025, Financial disclosures revealed a reality that the public was never meant to see. The largest artificial intelligence investment in history was hemorrhaging over $12 billion in a single quarter. If you annualize that burn rate, you are looking at nearly $50 billion vanishing into the ether every single year. Let me put that $50 billion into perspective so we can truly anchor this in reality. Nike, the global apparel empire. Starbucks, the ubiquitous coffee giant that sits on every street corner. Goldman Sachs, the titan of Wall Street. If you combine the entire operating expenses of all three of those behemoth corporations for an entire year, it still does not equal the amount of cash being incinerated in the pursuit of artificial general intelligence. Looking at their business model canvas, they were missing the most critical component of any sustainable enterprise, which is a mechanism to separate the cost of delivery from the scale of the user base. They were trapped in a linear cost trap in an exponential growth market, and the executives knew it. They sat in their offices, watching the server traffic data climb higher and higher, the coffee in their hands turning ice cold as they realized that every new user was a financial liability, not an asset. They had about 100 million weekly active users, a staggering, unprecedented number, but only a fraction, roughly 5%, were actually paying the monthly subscription fee. That gave them an annualized revenue run rate of about $20 billion. $20 billion in revenue sounds fantastic until you subtract the $50 billion in operational costs, the billions more required for constant research and development, and the unimaginable capital expenditures required to build the supercomputers of tomorrow. So how does a system like this survive? How does it avoid an immediate catastrophic implosion? It survives through a mechanism that I like to call the circular capital centrifuge. This brings us to the climax of the system, the frame-by-frame teardown of how this massive capital operation was structured. The executives realized they could not simply sell software to cover their costs. The unit economics were inverted, so they pivoted to selling something else entirely. They sold a story. They sold the ultimate science fiction narrative to the wealthiest entities on the planet. They sold the promise of artificial general intelligence, an omnipotent digital brain that could theoretically solve all human problems and capture all future economic value. If you control the machine that does all human labor, you effectively own the global economy. It is a pitch so grand, so terrifyingly massive, that traditional financial metrics cease to apply. But let us examine the mechanics of that $110 billion funding round, because this is where the engineering mindset is absolutely necessary to spot the fraud. Let us look at the individual moving parts. First, we have the hardware giants, the companies that design and manufacture the graphics processing units. They write a massive check, say $30 billion, and invest it directly into the artificial intelligence lab. The headline goes out: $30 billion vote of confidence from the most important hardware company in the world. The valuation skyrockets. The media cheers. But follow the money. Where does that $30 billion actually go? It does not go to payroll. It does not go to marketing. It goes straight back into the bank account of the very same hardware company that just invested it. Because the artificial intelligence lab is contractually obligated to use that capital to buy the next generation of server chips from that exact supplier. It is a closed-loop system. It is a recursive function. The money simply travels from the hardware company's venture capital arm into the startup, and immediately back into the hardware company's revenue column. The startup gets the servers, yes, but they also get an artificially inflated valuation. And the hardware company gets to report massive top-line revenue growth to Wall Street. It is an engineering masterpiece of financial distortion. Then we look at the cloud providers, the colossal tech monopolies that rent out server space. One major player pledges $50 billion to the round. Again, the headline is breathtaking, but read the fine print of the term sheet. This is where my experience dealing with venture capitalists makes my blood boil. Only $15 billion of that pledge is actually liquid capital provided up front. The remaining $35 billion is locked behind incredibly specific, almost impossible technical milestones. It is contingent on the startup actually achieving artificial general intelligence, a concept that the scientific community cannot even definitively define, let alone measure. Or it is contingent on the startup executing a wildly successful initial public offering. This $50 billion pledge is not a deposit. It is a phantom number designed to manipulate the narrative. Speaking as a serial founder, I have seen these types of structured deals before on a much smaller scale. They are designed to protect the investor entirely while leveraging the startup's brand to boost the investor's own stock price. The cloud provider gets to tell their shareholders that they own a massive stake in the future of artificial intelligence, driving their own market capitalization up by hundreds of billions of dollars. Meanwhile, the startup is left holding a bag of empty promises, desperately burning through the upfront cash just to keep the lights on for another few months. And then the cracks began to show, starting with the consumer product itself. You have to remember a famous statement made by the chief executive officer in a university auditorium back in 2024. He stood on stage and explicitly stated his personal hatred for advertisements. He called the combination of artificial intelligence and targeted ads uniquely unsettling. He claimed it was an absolute last resort, a business model they would actively avoid. Fast forward less than 2 years later. The company, suffocating under the weight of its own computing costs, quietly begins rolling out advertisements into their free tiers and eventually even their basic paid tiers. The user experience degrades. The latency increases. The pure magical interface is suddenly cluttered with sponsored outputs. In engineering terms, we call this technical debt coming due. You can only delay the laws of economics for so long before the system forces a correction. And this correction was violent. They declared a code red internally. Their main competitor, a massive search engine monopoly, started aggressively capturing user growth with their own version 3 model. Why? Because the search monopoly did not need to make a direct profit from their artificial intelligence model. This is the concept of cross-subsidization, a brutal corporate strategy. The search monopoly makes tens of billions of dollars every quarter from traditional search ads and cloud services. They can afford to lose money on artificial intelligence indefinitely. They treat the massive compute costs as a defensive moat, a necessary expense to protect their core search business. They integrate the language models into their email clients, their document editors, and their enterprise suites, giving it away for free to ensure no one defects to a rival platform. The standalone artificial intelligence startup does not have a legacy money printer to fund its war. They only have the money they raise. And so they found themselves trapped between a rock and an incredibly expensive hard place. They tried to launch groundbreaking new features like a highly realistic video generation model. It was technologically breathtaking. It could generate Hollywood-quality scenes from a single text prompt, but internally, the reality was a nightmare. The video generation model was costing them $15 million a day just to operate. It was computationally so heavy, requiring so much parallel processing and memory bandwidth, that it was deemed completely unsustainable, even by their own internal data scientists. It was a sports car with a jet engine that required a new set of tires every 3 miles. It looked great in the showroom, but it could never be driven on the open road. This leads us to the post-mortem and the inevitable rebuild. What happens when a system built on $110 billion of circular logic finally hits the wall of reality? What happens when a company that has committed to spending $600 billion on infrastructure over the next 7 years realizes that it needs to scale its paying user base to nearly half the population of the Earth just to break even? It forces a reckoning that extends far beyond the borders of Silicon Valley. We have to look at their closest competitor, a company built by engineers who split off from the original team precisely because they saw this structural failure coming. This rival company, let us call them the pragmatists, took a completely different approach. They did not try to build a consumer app for everybody. They did not chase the vague messianic vision of artificial general intelligence at the cost of all financial sanity. Instead, they built a highly focused, extremely safe, heavily constrained model designed specifically for enterprise businesses. They focused on data security, reliability, and predictable pricing. They built a tool, not a religion. and the market responded. While the giant was burning $50 billion a year trying to be everything to everyone, the pragmatists saw their enterprise revenue increase tenfold in a single year. Both companies were losing money, but the pragmatists were rapidly closing the gap. They had a clear mathematical path to profitability by 2028. They understood that in business focus is your only true economic moat. When I look at the difference between these two strategies, it is the classic battle between the visionary architect who builds a beautiful skyscraper with no foundation, and the civil engineer who builds a solid, boring bridge that actually holds weight. But the collapse of the giant is not just a localized failure. It poses a systemic risk to the entire global economy. By late 2025, artificial intelligence-related companies accounted for roughly 80% of all stock market gains in the United States. The entire narrative of future economic growth was pinned on the assumption that these massive investments in graphics processing units and data centers would inevitably result in a golden age of limitless productivity. The giant is now attempting the final, most desperate maneuver in the corporate playbook. They are preparing for an initial public offering. They want to list on the public stock exchange with a valuation of $1 trillion. They want to be valued higher than the largest banks in the world, despite having never generated a single cent of actual profit. This is the ultimate gamble, because the moment you file for a public offering, the illusion must end. You are legally required to open your books. You have to show the public markets the exact cost per query. You have to show them the real retention rates, the true cost of acquiring a customer, and the brutal reality of your hardware depreciation schedules. You have to expose the recursive funding loops and the phantom venture capital pledges. There are only two ways this ends. In the first scenario, the public markets look at the terrifying financial reality. Look at the $50 billion annual burn rate, and they simply refuse to buy the stock. The IPO fails. The capital dries up. The company is forced to undergo massive restructuring, laying off thousands of researchers, shutting down their most advanced models, and likely being sold for parts to a legacy tech giant. The ripple effect of this failure would be catastrophic. If the undisputed leader of the artificial intelligence boom is exposed as fundamentally unprofitable, it triggers a massive repricing of every single tech stock in the market. The hardware companies lose their biggest customer. The cloud providers are left with empty data centers. The venture capital funds have to write down hundreds of billions of dollars in losses. It would trigger a sharp, violent recession in the technology sector that would inevitably bleed into the broader global economy. In the second scenario, the public markets look at the horrific numbers. They look at the staggering losses and they buy the stock anyway. They buy into the narrative that traditional economics simply do not apply to this new era of machine intelligence. They accept the premise that whoever builds the digital god will eventually figure out how to monetize it later. This is the Tesla maneuver on steroids. But even if they pull this off, even if they secure their trillion-dollar valuation, the fundamental engineering problem remains unsolved. You cannot bend the laws of thermodynamics with a stock ticker. The servers still require power. The chips still melt without cooling. The cost of compute still scales linearly, while revenue scales logarithmically. Speaking as a builder who has spent a decade looking at system architectures, I can tell you that the future of artificial intelligence will not be dictated by massive, centralized monoliths burning the GDP of a small country every quarter. The physics simply do not support it. The system is too fragile, too expensive, and too reliant on a constant influx of external capital to survive its own weight. We are currently witnessing the end of the mainframe era of artificial intelligence. What comes next will be the decentralized, edge-computed, highly specialized era. We will see millions of smaller, hyper-efficient models running locally on our phones and our personal computers. We will see open-source algorithms optimizing specifically for low power consumption rather than raw parameter size. The $110 billion lie was the belief that you could brute force your way to profitability by simply throwing more electricity at a statistical probability engine. It was a fascinating experiment, a spectacular display of human ambition and financial engineering. But as the servers run hot and the capital loops begin to unravel, we are about to learn a very old, very painful lesson. You can engineer software to do incredible things. You can engineer hardware to process information at light speed, but you cannot engineer your way out of basic economic gravity. The numbers always catch up to you. That Tuesday morning in the boardroom, staring at the term sheet, was not the beginning of a new era. It was the frantic, desperate attempt to delay the inevitable. The system is collapsing, not because the technology is flawed, but because the business model was built on a foundation of sand. And when the tide comes in, all the venture capital in the world will not stop the water.